Good afternoon and welcome to BizTech Asia's Midday Market Watch. It's Friday, happy days, the 22nd of March. And our guest today with me, Jeffery, Halley, is Kelvin Wong, Senior Markets Analyst at Oanda in Singapore. Kelvin, welcome.
Hey, hi, good to hear from you again, Jeff, and happy Friday.
And to you, mate, and to you. Before we get into the interview, let's take a look at Asian markets. A sea of red today. It's certainly been a bit of an ugly session to end the week, given that US stocks finished fairly robustly last night. Taking a look at the Nikkei 225 in Japan, it's up just 0.29%, and it's alone in that grouping of being in positive territory. In China, Shanghai Composite is down 1.4%. The Hang Seng in Hong Kong, though, has tanked by 3.05%. Tough day at the office there. In Australia, the ASX 200 is down 0.23%. South Korea's Kospi down around 0.4%. Straits Times Index in Singapore down around 0.3%, with Kuala Lumpur down 0.12%. A bit of a tough day at the office there for equity markets in Asia. Kelvin, can you perhaps walk us through what's driving this actions?
Sure. So actually, if you look at the current situation right now in this risk-off behavior in the markets, especially as the current intraday weakness on the major US, call it even the E-mini S&P 500 and the E-mini Nasdaq 100 also fell a fair bit. So that kind of trigger a negative feedback look into the Asian market. So the primary driver over here is the sudden reversal of dollar. Let's talk about the dollar strength. So what's interesting over here is that we know that after exposed FOMC and exposed Fed Chair Powell pressure on that particular keyword that he used, that there's actually a foreseeable, we call it chance, that the Fed will actually starts to think about or even planning to actually slow down the pace of quantitative tightening. So that actually kickstart that dollar weakness seen about on Thursday. That's actually exposed FOMC, exposed Fed Chair Powell pressure. But what's interesting over here is that yesterday that dollar recovered significantly and totally removed off that prior day of dollar weakness. So what we could see over here is that very key technical levels has been taken out on the dollar index at this 103.70 level. So that's the level that we mentioned last Friday, which is a bunch of the 20-day, the 50-day, and the 200-day moving average. So that particular trigger of that dollar strength doesn't come from the Fed itself. In fact, it comes from other central banks. So as we know in the FX market, things are relative in nature. So what we could see over here is that there are actually two big, we call it surprise move by the Bank of England, especially the Swiss central bank, SNB. So SNB actually surprised market and they decided to go ahead to actually cut their benchmark, we call it policy rate by 25 basis points ahead of the Fed and ECB. Because the previous guidance by SNB was to actually follow the Fed and the ECB to actually cut around the summer months of this year. So we're talking about June to July. But they jumped the gun instead. And the reason for them given saying that the inflationary trend in Switzerland is more or less has been subdued. But I believe that one of the reasons they're actually looking at is the persistent strength of the Swiss franc against the euro currency. Especially we know that the last 3 months or so, the Euro Swiss has been actually tumbling down to close to coming to levels during that surprise devaluation of that Euro Swiss way back then. So what prompted them to actually reduce this we call it persistent Swiss strength against the European currency could actually prompted that earlier move cut by SNB. So on the other hand, we have another Bank of England. So as we know that Bank of England has been strangely or stubbornly having that cautionary stance on elevated inflation in UK. And even the last two meetings or so, they do have certain members actually voting for a hike instead. So what we could see yesterday, that particular two hawkish member actually skewed towards more towards the neutrality stance and actually remove their their vote to actually in favor of a hike. And overall, it has a 8-1 majority to actually 8 to stand pat, 1 to actually cut. So this is the first time that no member on the panel of BOE officials actually supported for an increase. And also during after the release of the BOE monetary policy outcome, which actually came in line with market expectations, so they keep their policy rate at 16-year high of 5.25%. But what's interesting over here is that during the interview to the press, when after the policy meeting outcome, Bank of England governor actually highlighted saying that the bank could actually move before inflation hits its target. So that's a very kind of a bold and dovish statement. I believe that's the first that we heard so far in the last we call it 1 year or so. Starting to we see the Bank of England governor starts to sway towards more on the dovish side rather than maintaining his cautionary stand that inflation remains elevated in UK. So that actually prompted that sell-off in the sterling pound as well. So net overall, these are the what I call it trigger that actually starts to see the dollar strength coming back into the picture, and market participants could actually potentially view that will that be a sign of some kind of currency war taking shape into the market, and that actually also lead to that Chinese offshore yuan to actually burst up to the dollar CNH, talking about the dollar versus the Chinese yuan to actually burst up to the upside as well.
Okay, let's turn our attention to stock markets briefly. So we've had a pretty bad day here in Asia, but overnight, despite this news around Apple and regulators, etc., we saw US stock markets pretty much making new all-time highs, just ignoring an unchanged Fed, an unchanged dot plot, all of this stuff this week. Is this because US yields have not really reacted to those inputs as well?
Yes, precisely. So if you look at from a absolute level perspective on the US Treasury yields, taking into account of that 10-year US Treasury yield, it still remains subdued below a key we call it lower limit of a key resistance zone, which is at 4.33%. So it still remains subdued around that level. But so far, it's still managed. Overall, it still can't manage to actually break below it after the FOMC meeting this week. So what we could see over here is that see a bit of choppy movement on the US 10-year Treasury yield. So so far for now, it still remains holding at the there's this minor range support at this 4.07%. So that's actually in place since 7th of February this year.
Okay, let's circle back around to the currency markets again. So we've seen dollar yen react quite surprisingly to my mind, given that the Bank of Japan raised interest rates for the first time in 17 years this week. Yet dollar yen itself has been quite strong this week. The yen has weakened above 150 to the dollar. But yesterday, we finally saw the Bank of Japan starting to make some of their classic watching markets closely noises. Should we be cautious about dollar yen above this 150 level at the moment?
Yes, precisely. Because don't forget over here is that it's a chicken and egg thing over here. You know what I mean? So yes, the Bank of Japan they actually are put in a way that they actually long due to actually normalize their ultra dovish policy. It's a long due because fundamentals in Japan doesn't support it. But they also do not want to see market speculators moving ahead of their guidance by actually taking what I call speculative bet by shorting the 10-year JGB bond. That means that could actually lead to a rise in the long-term, so-called long-term JGB above 1%. So that actually prompt the FX market to actually react negatively against the yen. So, but do not forget over here is that this year itself is also potentially an election year in Japan. And do not forget, the current prime minister popularity rating has been falling quite a fair bit. So one of the reasons over here is due to higher costs of living in Japan, and due to the weaker yen because of higher imported goods and services. And if in fact, if we talk about imported inflation, so if you look at today's Japan core inflation numbers, actually it came back up again. So it managed to actually, the core inflation managed to actually inch up from 2.8% in February, from 2% year on year in January. So that's actually a 4-month high level. All right. So what we could see over here is that imported inflation is still remain elevated in Japan, where the government officials actually do not want a very, very weak yen. So that actually explain why, especially when it comes to prompt to the psychological 152 level. In fact, this morning, the Finmin, the finance minister of Japan, came in and actually made some noise about this ongoing FX movement. So as usual, he's saying that the regulators are watching the FX market. Any undesirable move is not desirable. So giving a bit of what I call we call it a pause by short-term speculator from pushing the yen up above this level. So something very interesting to watch out for sure.
Yeah. Introducing some two-way market risk. I think it's quite interesting that we saw the S&B cut, we saw Mexico cut yesterday, we saw Turkey raise rates by 500 basis points. It's a complete, it's quite a menagerie of monetary policies. It looks like in 2024, we're going to see some quite stark divergence in the directions of monetary policies from different parts of the world. Kelvin, just to wrap it up briefly, looking at the calendar next week, is there anything really standing out for you for investors to be watching out for?
Sure. So for next week, a very quick look at my calendar. So for next week, there's actually kind of important data will come. The action will come on Friday. So Friday we have two important data. One is up from Japan. So Japan tends to have two inflation data to watch. One is the more leading one, which is the Tokyo prefecture PMI CPI data. So they tend to be about 2 weeks ahead or 3 weeks ahead of the nationwide Japan data release. So for next Friday, they will actually release the March Tokyo CPI data. So if you look at the one that is the Food and Energy, so they call it the cocoa rate. So that actually market is actually looking at the cocoa rate to remain elevated at 2.5% year on year. So in fact, it has been above 2.5% for I think the close of the last 2.5 years or so. So very clearly, Japan itself is not going back to what I call deflationary environment. And most importantly, market after that will shift their attention to the US PCE inflation data. So PCE inflation data is one of the I would say that the Fed actually used this particular metrics rather than the CPI. So there's a slight calculation difference, but market participants will be looking at the core PCE price index year on year. So they're actually looking for another further inch down to 2.7% year on year, from 2.8%. So that actually, if that actually moves in line, I believe that it shouldn't change much of a doubt in terms of the expectation of a very high probability of a first rate cut to come in June for the US.
Okay, great. Kelvin, thanks so much for being with us today and for being a friend of the show, and a wonderful weekend ahead when you finally get out of the office.
Sure, same to you.
We've been speaking to Kelvin Wong, Senior Markets Analyst at Oanda in Singapore on BizTech's Asian Midday Market Watch. I'm Jeffery Halley, and this video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. You can also see it with our syndication partners on their TV and radio stations, as well as their websites. I wish you all a wonderful weekend, and thanks so much for tuning in today.